All right, so now we have handout 6. So in handout 5, we did cash to accrual. And in handout 6, we're going to do accrual to cash, and we're going to prepare a statement of cash flows. So let's kind of take a look at what our statement of cash flows looks like and see what we need to do with the information that's given. So we have three different categories. We have our net cash flow from operating activities, from our investing activities, and then we have it from our financing activities. So something to do. Oh, and then at the end of it, we have our cash at the beginning of the year and our cash at the end of the year, and then we can see our net increase in cash and kind of check our work. So what I like to do is go through our balance sheet and kind of label which activity these fall under. And then we're also given an income statement as well, which we'll need. So looking at our balance sheet, we have the ending balance on December 31st, 2019, and our ending balance on December 31st, 2020. So if this is our ending balance on 2019, it's our beginning balance of 2020. So cash we'll worry about at the end. Accounts receivable has to do with our operating activities. All the money that we get, or all the money, or all the sales that we make on credit is our accounts receivable, and that has to do with our operations. And it was 12,000 at the beginning of the year and 18,000 at the end of the year, which means it increased by $6,000 during the year. Now our supplies also has to do with our operations. We need supplies to make the stuff that we sell, right? At the beginning of the year, it was 2,000. The end of the year, it was 4, which means it increased by $2,000 during the year. Our inventory also has to do with our operations. And so we're going to label that as operating activities. Beginning of the year, it was 14,000, and at the end of the year, it was 11. So it decreased by $3,000 during the year. Our equipment, while it does have to do with our operations, equipment is a big purchase. It's an investment that we make. So we're going to put that under our investing activities. During the year, or in the beginning of the year, it was 50,000, and at the end of the year, it was 56,000, which means our equipment increased by $6,000 during the year. Now, accumulated depreciation, while this has to do with our equipment, depreciation expense falls under our operating expenses, like we learned in handout 5. And so that's going to be an operating activity. And it was $8,000 at the beginning of the year of total accumulated depreciation. And at the end of the year, it was 12,000. So it increased by 4. Even though these are negative numbers, it still increased by 4,000, the expense. Now, accounts payable also has to do with our operations. And this is if we buy supplies and we can't pay for it, we pay it on credit. That has to do with our accounts payable. So that's going to go under our operating activities. It was 11,000 at the beginning of the year and 4,000 at the end of the year, which means it decreased by $7,000 during the year. Now, unearned rent also has to do with our operating activities. Maybe we rent out part of a building that we have and we earn income from that. So that has to do with our operations. It was 11,000 or 1,000 at the beginning of the year and 2,000 at the end. So it increased by 1,000. Now our common stock and our retained earnings has to do with our equity, and that's going to go into our financing activities. Common stock at the beginning of the year was 47,000, and at the end of the year it was 59,000. It increased by $12,000 during the year. And our retained earnings we'll worry about a little bit later. So let's take all of these and let's put them into our statement of cash flows. So first we're going to start with our operating activities. First number we need is our net income, which they give us here. Our net income is $9,000. So that's the amount that we're going to start with. And now we need to see what we need to add to our net income and what we need to subtract from our net income. This is on an accrual basis, and we need to add and subtract all these things to figure out what the cash was provided by the operating activities, what the cash basis net income is. Okay, so things that we need to add in. We need to add in our depreciation expense. We took away this expense, we minus this expense from our income on an accrual basis, but there was no cash involved with this. It was a debit to depreciation expense and a credit to accumulated depreciation. So on a cash basis, depreciation expense is not recorded. So we need to add back that expense that was subtracted from our accrual basis. Now our decrease in inventory, we lowered our inventory, but there was no cash involved in that transaction. So that decrease that we made on accrual basis, we need to add that back in for our cash basis. Now our increase in unearned rent. An increase in unearned rent would be a debit to unearned rent and a credit to cash. On an accrual basis, it's not recorded, it's not recognized until it's earned. So on a accrual basis, this unearned rent wasn't recorded, but we got cash for it. It's a debit to cash and a credit to unearned rent, excuse me. So we got cash for it, which is why we need to add it in for our cash basis. And it was because it wasn't added in on an accrual basis. So we need to add that in. Now, things that we need to subtract. An increase in accounts receivable. An increase in accounts receivable would be a debit to AR and a credit to sales. On an accrual basis, this is recognized, but on a cash basis, it's not. We didn't get any cash. So that increase that we made, we need to subtract it. We need to take that out of our accrual basis to get our cash basis. An increase in supplies, we did a debit to supplies and a credit to cash, and that wasn't recorded on an accrual basis, but we did pay cash for it. So we need to take it out of our accrual basis to get our cash basis. Now, a decrease in accounts payable would be a debit to accounts payable and a credit to cash. We paid out cash, we lowered that liability, but that's not recorded on an accrual basis. So we need to take that out because we paid cash for it. So we have our $9,000 accrual basis net income. We add in what we need to add in, we subtract what we need to take out, and this total right here is a $7,000 minus that we need to do from our accrual basis to get to our cash basis. So now we have our net cash provided by operating activities, $2,000. Now let's move on to our investing activities. So our equipment increased during the year. We bought equipment. That's a debit to equipment and a credit to cash. That wasn't recorded on our accrual basis. So we need to take that out to recognize our cash basis. We paid cash. We need to minus that out. Now, our financing activities. We issued common stock, and so that wasn't recorded on an accrual basis. So we need to add that in. Our common stock increased, and we paid out our dividends. So for our common stock, let me go back to that. That is a debit to cash and a credit to common stock. So we got cash, and so that wasn't recorded on an accrual basis. But we got cash for it, so we need to increase that cash. Now our payment of dividends, we paid out our dividends, which is a debit to dividends payable and a credit to cash. We paid cash for it. That wasn't recorded on an accrual basis, but it is reported on a cash basis. We have to take out that 1,000. So for the two financing activities, we have a net increase of 11,000. So we have our net increase from our operating activities. We have our net decrease from our our investing activities, and we have our net increase by our financing activities. So we have 2,000 minus 6,000 plus 11,000. We have a total net increase in cash of $7,000. And we can check that. Our cash at the beginning of the year was $8,000, and our cash at the end of the year was $15,000. 8 to 15 is $7,000. So one thing that we need to do is figure out how we got this amount for our payment of dividends, that $1,000. The $12,000 we know because our common stock increased by $12,000, but they don't give us any information about our dividends. But we have all the information that we need to figure out what that is. So if our beginning retained earnings was 19,000 and our ending retained earnings is 27,000 and our net income is 9,000, we can figure out what X is. Because our ending retained earnings formula is our beginning retained earnings plus our net income minus our dividends. So we have 19,000 plus 9,000 minus X, our dividends, equals 27,000. So X equals 1,000. And that's how you take all that information and create a statement of cash flows.